Hey guys, what's going on? Decided to make another video to follow up on my previous options for beginners before. Mainly because when in my previous video I did options trading for beginners. I covered buying and selling. However, I don't actually do any buying because I believe it's high risk and it's unnecessary. Since I believe in only the selling piece, I figured I'd make just a video on that. And similarly, the strategy that I have kind of goes with hand in hand with the wheel strategy. So as you can see at the top, I wrote, the wheel strategy, which basically, it kind of follows the same exact concept. So many of you have probably heard of the wheel strategy. But if not, I'll get into it and I'll explain. So let's start off with, what do you need to even begin the wheel strategy, or selling puts, selling calls, etc. Well, first you need a stock that you trust, because you don't want to just do this with any old penny stock, any company that you don't like, any company that you would not normally own. If you know of any companies that you are willing to pay, buy 100 shares of now and do not mind owning for a month, 2 months, 3 months, a year, maybe even longer, then that's the stock that you want. It needs to be a company that you trust, and we'll get into why later. Number 2 is you need collateral, which means you need enough money to buy 100 shares of that stock, which, when you're selling a put, your brokerage will require you post collateral for, in case the transaction goes through. So, and we'll obviously get into that. Another important thing is you need time. So time being, as far as the collateral goes, you need to be able to put that money aside for that time, or you need to be willing, you need to have that money for a specific period of time. If you need it back right away, this is probably not for you. But if you have the money and you can afford to lend it out essentially for a month, a week, whatever, then you're good. And last but not least, you need patience. As with investing in general, of course, patience is huge. When you get involved with, options, selling puts, selling calls, you tend to look at your phone or your computer a lot, and you'll see, your stock that you're in goes up and down, and you may or may not feel comfortable with that. So you have to be willing and be patient to understand, okay, regardless of what happens, then I'm okay with it. And we'll get into that obviously too. So I wrote a little diagram right here. This is basically the summary of it, the wheel strategy, or the strategy I'm talking about today. So you sell a put. If it's assigned, you sell a call. If it's not assigned, then you sell another put. And then so on and so forth. The wheel goes round and round. And that's it. That's basically it. But anyway, I provided an example. I used a stock, BAC, Bank of America, a stock that everyone knows. A stock that a lot of people wouldn't mind owning for a month, 2 months, 3 months, should they be stuck in that stock. And it's also a stock that you may not have in your normal portfolio. You may not be long on banks in general because, they screw up a lot. The Bank of America has been around forever. So if there is one for a long term, it's going to be that. It's going to be JP Morgan. It's going to be Wells Fargo. However, I don't own any banks. So banks are kind of on my options radar. They're a perfect stock that, I wouldn't mind owning, but I do not own right now. So they fit kind of in my options territory. Obviously, you'll have your own, but I'm just using an example, Bank of America. Now, in this example, the price, which is kind of accurate, is around $32. And today's date for this purpose, again, because I'm using expiration date, is January 21st. Now, what do we do? What are we doing? We have, we have a stock that we established. We have collateral, which means 32 times 100. You have $3,200 in collateral you're willing to post for this transaction, and you have time. So let's begin. So you're going to sell a put of Bank of America with a strike price of $31. So in this example, you actually only have to post $3,100 in collateral, because whatever you're selling the put, whatever the strike price is, that's the price that you're going to pay. So it's $31 times 100, $3,100 collateral would need to be posted. You're going to choose an expiration date of January 29th, which in this example, it's about a week and a day. So it's not a full week. It's a little more than a full week, not 2 weeks. The premium that you will collect is 20 cents per share. Times 100 shares, you'll get $20 in premium. So what that means is you're willing to buy Bank of America by this date for $31. Now, so what happens? What happens when you click sell put? Immediately, you get the $20 in your account. It doesn't mean you earned it all. It means they're paying you for that, because you can, you could essentially, you could buy it out early, which means, you have to pay a difference of that. I'm not going to get into that today, but over the time, by January 29th, that's when you fully earn that $20. But you do get it up front in your account. So when you click sell put, $3,100 is gone from your account, but plus 20 is added. Now, what do? You wait, right? You wait around, da-da-da. Here we go. January 29th is here. All right, here's the only question you have. Is the stock price less than $31? Because remember, $31 was the strike price that you chose. Is it less than $31? So there's obviously yes or there's no. Now, if no, then your collateral, your $3,100, is released back into your account. Now, at least I use Robinhood, and it's released to me the following day. So typically these expire on the Friday, so you don't get the collateral back until the Saturday morning. Other brokerages, they may wait till the Monday morning. I don't know, but it's probably the same. You probably just get it, you just get it the following day. So in this case, your collateral is released, right? So what do you do next? As you can see, this goes right up here, and you repeat. So, long story short, if this options does not get assigned, then you get your collateral back, and you do it again. You sell another put. So, and that's basically the idea. You don't really want to get assigned in reality. You just want to collect that premium. You want to collect that $20, and you want to move on with your life. I mean, if it's above the $31, great. You get your money back, you do it again. But as mentioned earlier, you have to be comfortable with this stock, because there is the chance it'll go under $31, and then you'll be assigned. You'll be paying $31. But I'll get into that. So obviously, here's a yes. You'll be assigned 100 shares of that stock at $31. So that $3,100 collateral is gone. It went to the buyer of the put. They got $3,100, because they basically sold the stock. You no longer have the $3,100, but you have 100 shares of Bank of America at $31. So what the hell can you do with that, right? Well, I'll tell you what you can do. You can do the other part of the wheel, which is selling a call. Since you own 100 shares of a stock, you can sell a call on that. So I wrote down another example. Let's assume at the end of that, you own the 100 shares, and the stock price is around $30, okay? So obviously that's why you got assigned, because it was less than $31. Now, you're going to sell a call, and you're going to choose an expiration date, which in this case is 2 weeks out, and you're going to pick a strike price, same as before, $31. And the reason I picked $31 is because you want to pick a price that's at least equal to what you paid, and not less than. I mean, it can be less than if have to, but I would like to stick with a strike price that's equal to or greater than what you paid on the original shares. So that's the strike price. As I mentioned, the current stock price is $30, and the expiration date, as mentioned, 2 weeks out, February 12th. And in this example, you're getting paid a premium of 25 cents per share. Times 100 shares, you're getting $25 for this transaction. Great, right? Now, you have, obviously, you sell the call and you wait. So, 212 comes, and then you have another question. Is the stock price greater than $31? If it's not greater than $31, then nothing happens. You still own the stock because no one wants to buy your option. No one wants these shares. So you're stuck with them. You know, no one's going to buy them. Obviously, the stock is not even worth that. So why would they pay $31? So long story short, nothing happens. And you can sell another call and then repeat and then go again. Keep going and keep going. And then until is the price greater than 31, if you come to a yes, then your shares will sell. All 100 shares will sell for $31. And then what happens? You have the 3,100 back. Essentially the collateral again. You have that money back. And all this time you're still getting the premium. You're collecting the $20 there, the $25 there. So what are you going to do now? You have 3,100 again. I'll tell you what you're going to do. You're going to follow this line up here and you're going to repeat again. You're going to sell another put. And then you're just going to keep doing this over and over and over. And the reason this is okay, like you may get stuck in a call situation. Like this stock price may go down to $28. So selling a call at 31 may give you, crap premium, 5 cents, something. But that's okay. It's better than nothing. So that's assuming again you're not willing to take a loss. You're going to keep the strike price at $31. You may judge the premium with the loss of the sell to balance it out. So essentially it's not a loss. But me personally, I'm only going to pick a strike price that I paid. So I'm never going to have a loss. With the buy and the sell is always going to balance out. If anything, I'm going to get a capital gain. And also, if you get stuck in the call situation, selling a call, you want to own a stock, again, that you like, and a stock that pays a dividend. Because, if you run into ex-dividend date and you still own the shares, boom, you get a dividend too. So, you're getting income all over the place. It's just another bonus. Now, as I said, people, they need to be, you need to be patient. You need to be okay, being stuck, owning the shares, because, it could tank. And maybe, you're selling a call for not that much premium and you're not seeing the end of the tunnel. So it's stuck at 28 and, you're not seeing progress, but you have to be patient. Patience, again, number 4. So, but like I said, this is it. This is the wheel strategy. What I do is I put aside separate money for options trading that I'm not investing in, my dividend stocks. What I do is the premium that I make, I say, okay, that's for my dividend stocks. So anything I make in premium goes towards my dividend investing, and so on and so forth. If not, it just gets added to my, the 3,100 or whatever I'm holding, so that increases over time too. Because again, you're limited depending on how much collateral you have. You can't do, Bank of America, this is one of the cheaper stocks. Apple would be great, but who the hell can afford that? Or Amazon, could you imagine? I mean, I can't. But anyway, you don't want to pick the cheapest stocks just because. You want to pick the stocks you can afford, obviously, and stocks you trust. So obviously, that's very, very important. But anyway, that's the wheel strategy. I hope everyone enjoyed this video. I hope you learned a thing or two. If you did, I would appreciate leaving a comment down below. Click like, share the video, or if you hated the video, leave a comment and all that. So that's all I got for today. If you like more of these videos, if you like options in general, if you want to see some samples, what I've been doing, then let me know. All right? I'm out of here. Later.